For making accounting information meaningful for the users, it is necessary that such information is reliable and comparable. This is possible only when such information is provided with consistent principles and policies. Accounting transactions are recorded with certain basic assumptions and common practices, which are called as accounting concepts and conventions. The Institute of Chartered Accountants of India, ICAI, which is the regulatory body for standardization of accounting policies in the country, has issued accounting standards which are expected to be uniformly adhered to in order to bring consistency in the accounting practices. Similarly, at international level, there are international financial reporting standards, which aims at bringing uniformity in reporting practices across the globe. Accounting concepts refer to the basic assumptions which are the basis for recording of business transactions and preparing financial statement. These are tenets or postulates used by accountants. Accounting conventions refer to common practices which are followed in recording and presenting accounting information. They are followed like customs, traditions in a society. Accounting conventions are evolved through the regular and consistent practice over the years to facilitate appropriate recording in the books of accounts. Going concern, consistency, and accrual are considered as fundamental accounting assumptions as per Indian accounting standards. Let's understand important accounting concepts and conventions in detail. First, going concern concept. This concept states that a business firm will continue to carry on its activities for an indefinite period of time. It assumes that the business will not be shut down or forced to sell its assets and close in the near future. This means the business is financially stable and is expected to keep operating for the foreseeable future. This concept is important in accounting, as it guides how assets are recorded typically at their historical cost, rather than resale or liquidation value. This concept allows accountants to prepare financial statements, such as balance sheets and income statements, under the assumption that the business will continue to function normally, allowing for long-term planning and investment, which influences how assets, liabilities, and expenses are recorded. For example, imagine you own a small bakery called Sweet Treats. According to the going concern concept, you buy an oven for $5,000. In the financial records, you record the oven at $5,000 and depreciate it over its useful life, say 10 years, because you expect the bakery to keep operating for years. And you also take a loan of $10,000 to buy supplies, expecting to pay it back over 5 years from the bakery's profits, not by selling the oven or other assets immediately. Your financial statements show the bakery's assets, like the oven, tables, and inventory, at their ongoing use value, not the amount you would receive if you sold everything tomorrow. Suppose Sweet Treats is struggling, losing money, and you plan to close it next month. In this case, the going concern concept doesn't apply. The oven might be recorded at its liquidation value, $2,000 if sold in second-hand market, instead of its original cost of $5,000. Financial statements would focus on how much cash can be raised by quickly selling assets, rather than on long-term profitability. And auditors may question the going concern assumption. If there is significant doubt about the company's ability to continue, they may include a warning in the financial statements. This would signal to investors and creditors that the business is not expected to continue, and it's helped them to take their decisions accordingly. Second, consistency concept. Convention of consistency means that same accounting principles, assumptions, and methods should be used for preparing financial statements year after year. Comparison between financial statements of an enterprise will be possible only when accounting policies and practices followed by the enterprise are uniform and consistent over a period of time. If different accounting procedures and practices are used for preparing financial statements of different years, then the result will not be comparable. Once a business chooses an accounting method, example how to value inventory or calculate depreciation, it should keep using it consistently. Example, imagine you own a clothing store called Trendy Threads, and you decide to value your inventory by using the FIFO, first in, first out method, where the earliest goods purchased are assumed to be sold first. In 2024, you report your inventory cost and profits using FIFO method. If you stick to this method in 2025, your financial statements will be consistent, and you can easily compare profits and losses between the 2 years. This consistency helps you, your accountant, or investors to see if sales are improving or if costs are rising over time. Suppose in 2025, you suddenly switch to the LIFO, last in, first out method without a good reason. Then, the consistency concept do not work. This could change how your inventory and profits are calculated, making it hard to compare 2024 and 2025 financial results. For example, in 2024, using FIFO method, your profit was $50,000. In 2025, using LIFO method, your profit appears as $30,000. But the drop might be due to the method change, not actual business performance. This inconsistency confuses business owners, stakeholders, and creditors. This makes your financial statements less reliable. Number 3, accrual concept. Accrual refers to something that becomes due, especially an amount of money that is yet to be paid or received at the end of the accounting period. It means that revenues are recognized when they become receivable, though cash may or may not be received, and the expenses are recognized when they become payable, though cash may or may not be paid. In accounting means that revenues and expenses are recorded when they are earned or incurred, not when cash is received or paid. Record income when the service or product is delivered, even if payment comes later. Record costs when they are used or occur, not when the bill is paid. Focuses on when transactions happen, not when money changes hands. Cash system of accounting contradicts accrual concept double entry system. Under the cash system, revenues and expenses are recorded and accounted as and when they are received and paid in cash respectively. GAAP usually does not permit application of the cash system of accounting. For example, if the firms make payment of salary every month for the earlier month, while recording salary in the books of accounts, even outstanding salary has to be recorded. This overall practices ensures that financial statements reflect the business's actual financial activity during a period, giving a more accurate picture of its performance. Let's imagine you run a small painting business called Color Splash. In December 2025, you paint a house and charge the client $1,000. The client agrees to pay you in January 2026. But under the accrual concept, you record the $1,000 as revenue in December 2025 because that's when you completed the work, earned the income, not when you get paid. Similarly, in December 2025, you buy paint supplies for $200 on credit, promising to pay the supplier in January 2026. You record the $200 as an expenses in December 2025 because you used the supplies for the painting job, even though you haven't paid yet. Let's see how it looks in your financial statements. Your 2025 income statement shows revenue, $1,000 from the painting job. Expenses, $200 for the paint supplies. Profit, $800. Revenue minus expenses. And let's see how your balance sheet looks like. Accounts receivable, $1,000. money owed by the client. Accounts payable, $200, money you owe the supplier. What if you used the cash basis, recording only when cash changes hands? Then the accrual concept does not work. You wouldn't record the $1,000 revenue or $200 expense in December 2025 because no cash was exchanged. Your December financial statements would show zero revenue and zero expenses, making it look like your business did nothing, which isn't true. Number 4, entity concept. This concept assumes that, for accounting purposes, the organization and its owner are two separate independent entities. The business and personal transactions of its owner are separate. When the owner invests money in the business in the form of capital, it is recorded as liability of the business. Similarly, when the owner takes away from the business cash or goods for his or her personal use, it is not treated as business expenses, but it is considered as withdrawal of capital. Thus, the accounting records are made in the books of accounts from the point of view of the entity and not the person owning the business. Let us take an example. Imagine you own a small coffee shop called Brew Bliss, and you invest $50,000 of your personal savings to start the coffee shop. You purchased coffee beans for $1,000 for the shop, furniture for $15,000, and plant and machinery of $30,000. $4,000 remains in hand. These are the assets of the business and not of the owner. According to the business entity concept, $50,000 will be treated by business as capital, a liability of business towards the owner of the business. If you take $4,000 from the shop's cash to pay for your personal bills, this is recorded as a withdrawal or owner's drawings in the business's books, reducing the owner's equity from the business, not recorded as a business expense. If you mix personal and business transactions together, then the entity concept doesn't apply. Suppose you record your personal purchase as a business expense. This would falsely reduce your coffee shop's profits, making the business look less profitable than it actually is. Investors or banks reviewing the financial statements might get a wrong impression of the coffee shop's performance, leading to poor decisions. Number 5, accounting period concept. This concept requires that a balance sheet and profit and loss account should be prepared at regular intervals. This is necessary for different purposes like calculation of profit, ascertaining financial position, tax computation, etc. Profit or loss of the business is measured periodically. This is measured for a specified interval of time called the accounting period, such as a month, quarter, or year. It ensures financial information is organized and reported at regular intervals rather than waiting until the business closes. Using the same time periods allows businesses to compare performance across different periods, like this year versus last year. Many governments and tax authorities require businesses to report their financials for specific periods, typically a fiscal year. From April 1st to March 31st, these financial statements reflect only the transactions within the particular accounting period, not the entire life of the business. If you didn't use a specific accounting period, then the accounting period concept doesn't work. And you might mix one year's sales to another year's expenses, making it hard to know how your business performed in a particular year. The accounting period concept ensures the expense is recorded when purchased and the revenue when sold. Keeping each period's financials is clear. Number 6, dual aspect concept. It assumes that every transaction has a two effect. It affects two accounts in their respective opposite sides. Each transaction has equal amount of debit and credit. For keeping the accounting equation of assets is equal to liabilities plus equity. This principle ensures that the financial impact of any transaction is recorded in two places, reflecting both what is received and what is given. Every transaction has a dual impact. One account is debited, increased or decreased, and another is credited, increased or decreased. This ensures the financial records are complete and the books always balance. Example to understand. Imagine you own a small grocery store called Fresh Mart. You buy inventory, groceries worth $5,000 in cash. Dual impact. What you receive, inventory and asset, increases by $5,000. What you give, cash, another asset, decreases by $5,000. Accounting entry. Debit. Inventory account, $5,000 because inventory increases. Credit. Cash account, $5,000 because cash decreases. If you only record one side of a transaction, then the dual aspect concept doesn't apply. Your books would be unbalanced. This would make your financial statements inaccurate, showing more assets than you actually own, or hiding debts, which could mislead investors, shareholders, and creditors. Number 7, disclosure and transparency concept. It means that a business must provide all relevant and significant financial information in its financial statements clearly and honestly. Transparency helps build trust and enables informed decision-making by presenting a complete and accurate information of the businesses and its activities. Business must provide all financial information to all interested parties like investors, lenders, creditors, and shareholders. The shareholder would like to know profitability of the firm, while the creditor would like to know the solvency of the business. In the same way, other parties would be interested in the financial information according to their requirements. This is only possible if financial statement discloses all relevant information in full, fair, and adequate manner, like assets, liabilities, revenues, expenses, and risks must be disclosed in the financial statements. Additional explanations to clarify complex transactions and accounting policies. Businesses must not hide or manipulate any information that could affect stakeholders' decisions. Imagine you own a small furniture store called Woodworks. In 2025, your financial statements show a profit of $3,000, assets of $10,000, and liabilities of $4,000. To follow the disclosure and transparency concept, you should include notes in your financial statements to provide more details. Accounting policy. You have to explain that you use the straight-line method to depreciate your delivery trucks, so stakeholders understand how asset values are calculated. Pending lawsuit. You need to disclose that a customer has filed a $1,000 lawsuit against Woodworks for defective furniture, which could impact future finances. Even though it's not settled, this transparency warns investors of the risk. Loan details. You note that a $2,000 bank loan is due next year with a 10% interest rate, so creditors know the repayment terms. By sharing these details, you ensure that anyone reading your financial statements, like a bank or investor, gets a clear, complete understanding of Woodworks' financial health, including potential risks. If you hide the lawsuit or don't explain your accounting methods, then the disclosure and transparency concept doesn't work. Stakeholders might think Woodworks is more profitable or stable than it actually is. For example, if you don't disclose the $1,000 lawsuit, an investor might overestimate your financial strength and invest in your business, only to lose money later if the lawsuit leads to a big payout. This lack of transparency could also lead to legal penalties or loss of trust from banks, investors, or customers. Number 8, Materiality Convention. The Convention of Materiality states that, To make financial statements meaningful, only material fact, important and relevant information should be provided in the financial statements. Material fact means the information which will influence the decision of its user, like business owners, management, shareholders, investors, lenders, and creditors. An item of $500 may be immaterial for a firm whose turnover is in millions of dollars. This may not be the case for a firm whose turnover is a few thousands of dollars. This concept helps businesses to focus on what's important and what to avoid. Major transactions or events must be recorded accurately, while small ones can be simplified or omitted if they're not significant. It helps accountants save time and effort by focusing on details that matter most to stakeholders. Imagine you run a small dairy shop called Sweet Bites. With annual revenue of $100,000, you buy a new refrigerator for $5,000. This is a material expense because it's significant relative to your business's size and could affect decisions. You record this purchase in detail, including depreciation over the refrigerator's useful life, in your financial statements. On the other hand, you buy a $20 spatula for the kitchen. This is immaterial because it's a tiny amount compared to your overall finances and won't influence stakeholders' decisions. Instead of tracking the spatula's depreciation separately, you might just record it as a general expense immediately to simplify accounting. If you treat every small item like the spatula as material, your financial statements would be cluttered with unnecessary details, making them harder to read and analyze. Conversely, if you treat a material item like the refrigerator as immaterial and don't disclose it properly, you might mislead investors or shareholders about your business's financial health. Number 9. Conservatism or Prudence convention. This convention is based on the principle that anticipate no profit but provide for all possible losses. It provides guidance for recording transactions in the books of accounts. This convention clearly states that profit should not be recorded until it is realized, but if the business anticipates any loss in the near future, provision should be made in the books of accounts for the same. Avoid overly optimistic reporting that could mislead stakeholders, like investors or creditors. Income or gains are only recorded when they are earned and assured, not just expected. This conservative approach ensures stakeholders aren't misled by inflated profits or assets. Imagine you run a small electronics shop called Tech Trend. Scenario 1. You sell $5,000 worth of laptops to a customer on credit. You're worried the customer might not pay due to their financial troubles. Following the Prudence concept, you record a provision for bad debts, an estimated expense of $5,000 in your financial statements, even though the customer hasn't defaulted yet. This reduces your reported profit but reflects the potential risk cautiously. Scenario 2. You're negotiating a $1,000 contract to supply computers to a school, but the deal isn't finalized. Under the conservatism concept, you don't record the $1,000 as revenue in your financial statements because it's not yet certain. You only record it once the contract is signed and the computers are delivered. How it looks in your financial statements. Your income statement shows a $5,000 expense, provision for bad debts, reducing profit. Your balance sheet shows a reduced accounts receivable, $5,000 less, due to the provision. If you ignore the potential bad debt and don't record the $5,000 provision, then conservatism or prudence convention doesn't work. Your profits and assets look higher than they should. If the customer defaults, your financial statements will suddenly show a big loss, surprising stakeholders. If you record the $1,000 contract revenue before it's finalized and the deal falls through, your financial statements will show inflated profits, misleading investors or banks about your business's true performance. Number 10. Matching concept. The matching concept is an accounting principle that requires the identification and recording of expenses associated with revenue earned and recognized during the same accounting period. Under the matching concept, the expenses of a particular accounting period are the costs of the assets used to earn the revenue but is recognized in that period. Therefore, that when expenses in a period are matched with the revenues generated for the same period, the result is the net income or loss for that period. Example to understand. Imagine you run a small bakery called Cake and Bake. In March 2025, you bake and sell 200 cakes for $1,000 of revenue. To make these cakes, you spent $300 on ingredients like flour and sugar in February 2025. Under the matching concept, you record the $300 ingredient expense in March 2025 when the cakes are sold, because those costs directly help to generate $1,000 revenue. Your March 2025 income statement would show this: revenue $1,000 from cake sales, expense $300 cost of ingredients, profit $700 revenue minus expenses. What if you don't follow the matching concept? If you recorded the $300 ingredient cost in February 2025 when you bought them instead of March 2025 when the cakes were sold, your February financials would show a $300 expense with no revenue, suggesting a loss. Meanwhile, March would show $1,000 revenue with no expenses, inflating profits. This mismatch distorts your bakery's true financial performance. Number 11. Money measurement concept. It means that only transactions and events that can be measured in monetary terms, like rupees, dollars, euro, etc., are recorded in a business's financial records. Non-monetary factors, such as employee satisfaction or brand reputation, are not included in financial statements, even if they're important, because they cannot be quantified in money. For example, important business meeting may be valuable, but it is not recorded. Similarly, a motivated and honest employee joining business is also not recorded in books of accounts, whereas transactions like sale of goods worth $2,000, purchase of raw materials $1,200, rent paid $130, etc., are expressed in terms of money, and so they are recorded in the books of accounts. Key points of the money measurement concept. Monetary focus. Only transactions with a clear monetary value, example, cash, assets, or liabilities, are recorded in the books of accounts. Common unit. Money provides a standard unit to measure and compare all financial transactions, making accounting consistent. Excludes non-monetary items. Things like employee skills, customer loyalty, or market reputation, which can't be easily valued in money, are not recorded in financial statements. Simplifies reporting. Focusing on money keeps financial statements clear and objective for stakeholders, like investors or creditors. Example of non-monetary events, like your store gains a reputation for excellent customer service, which attracts more customers. While this is valuable, it can't be measured in dollars, so it's not recorded in the financial statements. Suppose you hire a highly skilled professional, boosting your team's creativity. The professional's talent isn't recorded in the books of accounts because it doesn't have a specific monetary value. Let's assume a competitor closes down, potentially increasing your sales. This event isn't recorded as it's not a direct monetary transaction. Number 12. Cost concept. As per cost concept, all assets are recorded in the books of accounts at their purchase price, which includes cost of acquisition and expenses incurred to put it for use. It means that fixed assets, like building, plant, machinery, furniture, etc., are recorded in the books of accounts at a purchase price and not at current market price. The cost is based on actual transactions, example, receipts or invoices, avoiding subjective estimates. Using historical cost keeps financial statements consistent over the time, as values don't fluctuate with market changes. Example to understand. Imagine you run a small cafe called Brew and Bites. In January 2025, you buy a coffee machine for $8,000. According to the cost concept, you record the machine in your financial books at $8,000, the actual amount you paid, even if the market value of the coffee machine rises to $10,000 by December 2025 or drops to $6,000, you still keep it recorded at $8,000 in your balance sheet, minus any depreciation, which is calculated based on the original cost. What if you don't follow the cost concept? If you recorded the coffee machine at its current market value of $10,000 instead of $8,000, your assets would appear higher, inflating your financial position. This could mislead investors or banks. Market values can be subjective and fluctuate, making financial statements less reliable. The cost concept ensures objectivity by sticking to the verifiable purchase price. Thank you for watching. If you enjoyed this video, don't forget to give it a thumbs up. I'd love to hear your thoughts, so drop a comment below. And most importantly, hit that subscribe button and press the bell icon so you never miss an update.